All right, here we go. Welcome to Portfolio Builders 12/17/2019 Trade Alert. Goal of today's trade is to speculate with a very conservative, ultra safe strategy that quantitative easing will rise asset prices. We have a unique point in time where we have three of the major four central banks adding capital to their balance sheet, which means they're buying up government bonds. And on top of that, which is not accurately reflected in some of the charts we'll look at today, is a phenomenon called repo. And we're seeing repo grow in Europe and the US, as well as China, quite rapidly. Also, we'll learn why repo is far more attractive to banks at this point in time than quantitative easing is. The banks like quantitative easing after they've loaded up on bonds early before rates are dramatically cut, and then they like to have quantitative easing so they can sell those for a maximum profit. So we've seen this time and time again, and it's happening right now. In fact, in the next 30 days, we're going to see $500 billion added into repo, which will be very bullish for most asset classes. We'll see how it performs on the TLT in the short run, but I'm very bullish on emerging markets, gold, specifically gold miners versus spot gold, and then of course the S&P 500, which has been the all-star for quite some time. Now, if you do look at PE multiples, emerging markets is selling at a tremendous discount relative to the SPY. That doesn't necessarily matter when you're trading with funny money, and when rates are near zero, that's what we're trading with. So today's presentation will start off by looking at the trade document, and then we'll jump into our topical news that I've collected over the past 24 hours. Then if we have time, we'll take a sneak peek at how our strategy works, why it works. Now, I have been aggressively marketing our module 1 piece of that video to everyone, so hopefully you have watched that and do understand why our stock bond strategy is so lucrative and works so well. All right, let's just jump in right away. So today's trade alert is to essentially exit the last position. So if you took the last position, most likely you were assigned. You got a break even on your short call, and essentially you're able to keep the option premium we collected and sell your shares because you were exercised and assigned. And this means you're in cash and you're long a put option. We paid approximately 24 cents for that put option, and we're getting about 4 cents back. So we lost 20 cents a share on that trade alert. And the previous trade alert was one which had very little to lose if the market went higher on emerging markets. However, had the trade deal faltered, we stood to gain around 75 cents to $1 per share. So that trade did not work out for us, as China did agree to the trade deal, at least as much as saying that they would do their best. So whether you want to call it a trade deal or a ceasefire, regardless, the escalation has de-escalated at the same time that the central banks are printing massive amounts of capital. And what's the strategy most hedge funds use? It's not very complex, and it's very similar to what I'm teaching you guys. It's to build a highly diversified, uncorrelated basket of assets, which allows them to generate consistent returns with low volatility. That's what big investors really want, and what we're going to teach you how to do in today's webinar. So today's trade is the exact opposite of the last 2 weeks. We were playing a very safe down bet on emerging markets, and today we're flipping that trade. The setup is to purchase the January 10th, 2020 44.23 put. And yes, that is an extra 23 cents on there because of their dividend payouts. So we missed out on that. Big whoop. There's a lot of potential upside on emerging markets. Let me take a look at its chart so you can get a feel for it. Now, let's see if the prices are still similar. So I entered this when it's trading at 44.20, and it's currently trading at 44.23. So that's good to go. Let's pull up the chart. So you got to ask yourself, why are the best hedge fund managers in the world, the most legendary hedge fund managers like Ray Dalio, Stanley Druckenmiller, Jeffrey Gundlach, really three of the best money managers in all of history. Why are they so bullish on emerging markets? And so it's been a tough ride for them investing in emerging markets over the past, really the past 2 decades. It's just kind of gone nowhere. My expectation is that as long as the Chinese live up to these agricultural purchases, maybe some energy purchases, the US is going to allow them to continue raising capital through US markets. And that's exactly what they want to do. In fact, the Chinese want to raise around $3 trillion to fund their Belt and Road Initiative, which is critical to keep their GDP from crashing sub 6%. And if we really want to believe that US equities, European equities, and Asian equities can hit a bottom, and then we can see positive GDP growth, and that what the Federal Reserve and other central banks are trying to do to save the day will work out, well, China is going to have to stop this collapse in their GDP. So we'll see if this plays out, and I'll be paying close attention to whether China is hitting around $3 to $5 billion a month of agricultural products to at least get near to the claims that Lighthizer has given us. Bottom line is, with massive money flooding the banks, hedge funds using a very generic strategy just to really buy everything, there's a whole lot of money that could potentially be flowing into emerging markets ETF. It's the third highest traded ETF after SPY and the QQQ. So this is a large position, relatively the same size as we have in our portfolio in both Stanley Druckenmiller and Ray Dalio. Now we're at a 10% total allocation in emerging markets. They're upwards of 20%. So they're extremely bullish on emerging markets. And what are the big companies that we have access to in emerging markets? The most important are Alibaba, the competitor for Amazon, and then Tencent, which is a massive conglomerate technology company that competes with everyone from Facebook to Microsoft. So a lot of good reasons to own emerging markets. Also in Asia, we have 2/3 of the population. So if you think about that, they have a lot of potential sales to generate if they can grow in that area of the world. Now, on the other hand, if trade war escalates, we'll be more than happy to bet down. And you can see just how volatile this product is. And the main risk is that it's hosted in America. Okay, so this can be completely cut off by the US government if things go wrong with China relationship. And this is really one of the few ways China has access to outside capital for their corporations. So with that in mind, in terms of where I think we might find ourselves in early 2020, at a minimum, back to that 2017 high. Now, what happened in 2017? First, we saw cryptocurrencies crash. Then we saw emerging markets crash. And then by the end of 2018, we saw the US stock market crash. And that's what freaked out all the central banks and turned them from being monetary hawks to monetary doves. And they've done the Powell pivot in February of 2019 and continued to cut rates 3 times in 2019 and add more to the US balance sheet in the last 2 months than they ever have in history. And what they're about to do in the next 30 days is unheard of. $500 billion hitting the repo market. So that's our trade setup. In terms of where I'll start to get a little more defensive and protect against the sell-off, will most likely be as we approach that $51 price point. I think at that point, it'll get a little sticky and have some resistance until we see what's going to come of this phase 2 trade deal, which is now the next thing for markets to climb a wall of worry. Okay, so that's a look at emerging markets. Let me go through our trade alert. So once again, if you were assigned, you do need to pick up your 100 shares of the SPY. And again, for every 100 shares of the SPY ETF, we're recommending 200 shares of emerging markets. So that's how we balance the relative value of emerging markets against the SPY. 40% in the SPY, 10% emerging markets. If we scroll down, we do have a review of our trading plan. which again is to trade the SPY ETF Monday, Wednesday, Friday, emerging markets on Tuesday. Now, the next several Tuesdays, we're not going to be touching the position. What's going to either happen is emerging markets is drifting higher, in which case our put option will lose value and we'll be realizing profits in emerging markets. Or if emerging markets do head lower from here, we've already set our maximum loss today by purchasing that at the money put. So really our maximum loss going into this trade is 61 cents. But in terms of where I think we could travel to, there's an easy $7 of upside that we can see just to get back to 2017 levels. Now, again, this does represent 10% of our portfolio. So we're risking around 1.2% from here through January 10th. And the potential return is well over 10%. So I like that risk to reward ratio when we realize that we're about to pump up the banks with a lot of capital, and we understand the way hedge funds trade is a very shotgun approach where they just load up on everything and follow a very similar strategy as we are, where they have a basket of uncorrelated assets that all protect one another. Now, what they're not doing is as much downside protection as we are. They're willing to have much larger swings in return as they are competing amongst one another for the billions and billions of dollars out there. Our audience is not so concerned with outperforming anyone. In fact, our audience is really more concerned about not losing capital. So you'll see that we take what the big hedge funds do to already protect their portfolios and take it a step in the safer direction with extreme protection via put options. Okay, on our open positions, we're flat on our SPY trade alert. It's probably up a little bit. Let's see where that's at right now. Just pull that up. It was up this morning and it's up right now. So we entered this trade at 319.76 yesterday, and it's currently at 319.96. So we're up 20 cents on the underlying. We're really going to see big profits on this after we've gone up by $1. So I do anticipate placing this trade almost every day through the holidays. I'll probably give us one longer trade either on Monday or Wednesday so that we can have a few days off to get through Christmas and the New Year's. So with this setup, we profit dramatically the second we get above 321, where we have a long call option. On the other hand, we have extreme downside protection. If anything goes wrong, we're protected. We get 320 per share on the SPY, and that's because we purchased that put. So this is a very smart way to bet that there's some big moves ahead for the SPY. TLT trade, despite the market flying higher, TLT is not selling off. This is a very bullish sign, and we'll understand a little bit more why the bond market's so popular with primary dealers at this point in time. And it goes back to repo gives them essentially a double payday. They can buy the bonds, get the interest rates. They don't even care what yield it is because they know in the long run rates are headed lower, and eventually the Fed will go into quantitative easing to pick up their notes and bonds for a large profit. So they're getting really three paydays: interest, they get to lend it to the Fed for cash to lend out to broker dealers for a second income source. And then finally, once the rates are lower, they'll be able to flip them during quantitative easing after rates have dropped for a capital gain. So it's really hard to beat that deal. And you'll see proof that all these big banks, primary dealers, are not selling their treasuries, they're hoarding them. Okay, we got a question. When do you sell the next day? No, we're going to be holding these positions. I'm expecting a very big move up on all of these assets going into 2020. Now, I would say that I wouldn't suspect to realize a big gain on the TLT and the SPY on the same day. What we're seeing right now is the SPY is leading the market higher and TLT is holding its ground. So it's not selling off like you would expect, which is very bullish overall for both of these. And in fact, what we're going to learn is the higher the TLT travels, That means that access to capital is getting cheaper and cheaper, which is even more and more bullish for equities markets. Because if you can borrow at a very low interest rate, you're going to be more likely to speculate that you can generate a profit leveraging up on stocks and bonds in this case, as well as GDX. GDX is the gold miner ETF. And in this trade setup, once again, we are buying a position, which we did last week, and we entered our maximum loss at the point of entering the trade. We did that by purchasing an in-the-money put option. So the GDX was trading at 27.46, and I purchased a $28 put. This means I get $28 a share, worst case for GDX, and to achieve that, I had to pay $1.15. So if you look at that, we're losing about 60 cents, 65 cents maximum on GDX between now and January 10th. So that's about a 2% risk on this position. However, I think this position can actually appreciate by more than 10%, a greater potential return in 2020 for GDX than emerging markets. Now, gold and emerging markets are highly correlated. So I do suspect that we will see those two jump up at very similar intervals. Now, they're not exactly correlated, but there is a high level of correlation between those two. Now, let me go ahead and open this up for a quick round of questions before we continue, just so we can make sure we're all on the same page. And we got some more people live. Rocky Romero, welcome. I'm gonna go ahead and unmute all. All right, guys, everyone's microphone is unmuted. Any questions so far? Pete, is this all making sense to you and Mark?
Question, how is it that you have a put for GDX that's higher than its price?
Right, so that's called an in-the-money put. And so the catch is, obviously, if we're going to get paid more than it's worth, well, what did it cost us to get that right? So we purchased the GDX shares, or at the time of entering the put, it was at 27.46. I had to pay a premium of $1.15 for the right to sell my shares for 28. So that's called an in-the-money put. That's a very defensive play. So we just have to calculate the differences here to see our maximum loss. And I'll do that real quick. Just that's a good opportunity to learn for everyone. So if I am able to sell my shares for 28 and I entered it for 27.46, that's a profit of 54 cents. But I had to pay $1.15 for that right. So if I subtract the $1.15, you can see at the point of entering this trade, I agreed to a 61-cent loss. Now the catch is, that's my downside protection. If it goes any lower, it doesn't matter. My maximum loss from here on out on GDX is 61 cents. So what does that mean? Well, my break-even point, as soon as this price right here is 61 cents above. So my break-even point is going to be 28.07. So anything after that becomes pure profit. But meanwhile, if GDX goes to zero, doesn't matter. I still get $28 a share. So this is a great trade if you're expecting a big move up and you don't want to have any downside risk. So I entered the maximum risk the second I purchased that put option. Does that make sense?
Yes, it does. One quick follow-up question. Why did you pick January 10th as the end of that?
Okay, so January 10th is going to get us all through the holidays, and I'll probably purchase another 1 month put option. My expectation is to play GDX, the TLT, not the SPY, but emerging markets TLT and GDX just like this with longer term put options until I think they're too expensive. And here's what I want you to note about that. In fact, if I pull up my webinar presentation, there is something I want you to recognize about the nature of these two assets. So here's a look at the SPY ETF. And what I really want you to notice just visually is that the SPY ETF tends to just climb up almost always. Very rarely are there any red bars. Okay, the TLT does not behave that way. The TLT actually does the exact opposite. It sits there and trades flat or slightly down until stocks sell off. And then what does the TLT do? That's the orange line below. So note, every time stocks have a significant sell-off, that money goes somewhere. It goes into the bond market, and that drives the value of bonds sky high. So with the SPY, we can trade it slightly differently than the TLT and GDX. With the SPY, it's more likely to see nice consistent returns and then sharp sell-offs, which makes our strategy really nice because we have extreme downside protection on the SPY, but we benefit as long as it travels higher. You can't trade the TLT and GDX like that because it tends to do the opposite. It'll sit there and trade flat or slightly down, and then it pops up dramatically higher. So we don't want to miss out on the big pop in the TLT or GDX.
Okay, makes sense. Thank you.
Sure. So yeah, two different beasts, and so we can trade them slightly different. We can actually save ourselves a lot of money with a 1 month put versus having to purchase them weekly. Now with the SPY, because it has option expirations 3 times a week, I can actually design our trade to sell call options to finance the downside protection, and we can just hover with the SPY more frequently. And so the catch is that if we do end up on these positions, all of a sudden our put option will lose value and stops providing that downside protection. Any other questions out there before we continue?
Yeah, Jason, I have a question.
Sure.
I just tried to buy a put on my Ameritrade account online, and it says they require non-standard options to be put in by a broker, so I need to call them.
Yeah, call them and make sure you have level 2 options approved and ask them what's going on with that. But yeah, that's the 3rd highest traded ETF in the world is emerging markets. So it should be, and it's a US listed product, even though it's an ADR that's giving you exposure to China, India, South Korea. It's everything except Japan and Asia pretty much.
I thought it was odd because I was wondering if anybody else had that experience with TD Ameritrade.
And what was the exact error you got?
Non-options, non-standard options require broker, I guess broker assistance. I'll try it again right now. Let's see, view option change, January 10th.
All right, great. Yeah, let us know how that goes, Pete, and Dean can even give you a call after the webinar and make sure you get taken care of, okay?
Okay, great.
Any other questions out there before I continue the presentation? Okay, great. I'm gonna go ahead and mute us all one more time and continue on. Except for Dean, I'll keep Dean live. All right, so that's a wrap of that. What I have next in the trailer is a review of our returns, which is another thing that most gurus just don't do. They have terrible accounting. You know, there's bad trades are just hiding under the carpet, sneaking it under the bed. They don't have position sizes. There's no real return. It's not a real strategy. It's more like, hey, here's a trading idea. Go wild. Good luck. Not our program. So we've generated profits in 12 of the last 13 months. November was essentially flat, but slightly positive. Only loss was 1% in July. That was protecting against the potential for a trade war escalation. Other than that, we've averaged just over 1% a month. And now that we're past this trade war, I'm willing to take a lot more risk on. Through September, October, and November, I was really ratcheting up the defense in case things went awry with the trade deal. And they still might, but I think we have several months of peace, and we can simply watch if China's living up to their agricultural products for a good idea of things are on the verge of escalating. More likely, I think Trump's going to focus its efforts after the impeachment trial in the Senate on euro, which has been artificially pushing the value of their currency lower so they can dominate exports, as well as a massive trade deficit there as well. So that's probably his next tariff charade coming up. The next thing I do is break down the returns per asset class. So you can see that, you know, individually, sure, we're hitting a positive return on all of them by being able to accurately predict the big general move. But you can see there's not 12 out of 13 months generating a profit. There's only usually 3 months that have lost and 9 or so that have won on any individual track record. It's really when you overlap the strategy that you get the best results. And now, real quickly, I do want to point out that we really have 3 simple strategies that should work for the better part of 2 years. And what I want you to know is we're not going to be changing the underlying assets no matter what. Those are set. You can buy them, hold them, and protect them with our options in all market conditions. So note that I have the positive sign on SPY emerging markets TLT and the relatively flat sign on GDX. If the trade war is up in the air, we're going to be long stocks, bonds, and emerging markets. And we're going to be relatively protective on GDX. And this is because interest rates are low, so money is cheap. Inflation is low, so there's no fear of the Fed hiking interest rates. And we're entering quantitative easing. So these are the perfect ingredients for a market bubble. So we can design our option trades to benefit from a bubble up. Now, if the trade war escalates, we've seen time and time again, what happens is the SPY and emerging markets will sell off and the TLT and GDX will rocket higher. So that's why we want to be ready to catch a big win on the TLT and GDX and then lock in those profits. We don't want to be short a call option until we think those have been overbought. Now, if the trade war is truly de-escalating, we've seen in general that the SPY and emerging markets will travel higher and that it's negative for bonds and gold. This time around, the trade deal was certainly a de-escalation, but it's still not really resolved a lot of concerns. We still don't know if China's really going to buy agricultural products. So we're really more in a mixture of de-escalating and up in the air at this point in time. Now let's look at our 3 trade setups. So we have a bullish loose option caller. This is where we sell an out of the money call and buy an out of the money put. We're still protected from downside risk because we're long a put option. But this is going to allow the underlying asset to appreciate and generate a nice profit. So this is one of our favorite trade setups if we don't think there's a lot of risk to the downside. So after a big sell-off in an asset and we think it's going to go back up, this is a great trade setup. Now the neutral tight option caller is a little bit better if you think the asset has already traveled up and it's getting expensive. We still expect it might go up, but there's a bigger risk for a sell-off. And so with a neutral tight option caller, we're going to buy a much more valuable put that limits our risk. And we're going to sell an at the money call option so that we actually generate a profit if it goes flat or up. We don't care. We're going to make the same profit. And then finally, this is a rare trade, especially when there's quantitative easing and rates going lower and lower. But if we do think a certain asset in our portfolio is headed lower, this is one of the most profitable trade setups we can possibly put on. In fact, you can see, unlike the previous 2 where we get a 1-to-1 risk to reward ratio, in the third setup, we get a 2-to-1 risk to reward ratio betting down. Now, one of the reasons why this is so profitable is assets tend to drop a lot faster than they rise. So we can predict that and get much larger gains with less risk. So I love this trade setup. It's just rare that we will actually put it on. In this setup, we're going to sell an in the money call and buy an in the money put. And this allows us to own the asset, collect a huge premium, selling an in the money call option, and then turn around and buy an in the money put. So it's actually the best way to profit from an asset going down. If you're just sitting there trying to buy put options, you're going to learn pretty quickly that you're going to be very shy about putting large wagers, because when you lose a huge amount of money. This allows us to put a big chunk of capital to work, bet down with very low risk. So I'm going to go ahead and unmute one more time and make sure we all can follow these 3 slides. Does that make sense to everybody? Do those 3 trade setups make sense to you, Mark?
I'll say about 60%.
Okay, well, hey, that's fair enough.
If you could come up with a slide that you can compare them side by side, that might help explain what's going on.
Sure. Well, let's just flip through it one more time. So here's what we need to keep track of in the 3 slides, and this will really help you out. So we're starting at 298 SPY. In the first example, I'm selling the 301 call, and I'm buying the 295 put. So I'm selling a call option $3 above, and then I'm buying a put $3 below. So I can make up to $3, or I can lose up to $3 with a bullish option caller. If I do a neutral tight option caller, I'm selling my call option at the same price of the SPY, so picking up a large premium, and then I'm buying a put option only $1 below. So you can see I can only win or lose $1 or $100 per contract. And in a bearish option caller, I'm selling a call option $1 below the trading price, and I'm buying a put option, which is in this case $2 above. So this sets me up to lose as much as $1 if the SPY goes higher, but win up to $2 or $200 a contract if the SPY goes lower. So I'm not going to go over this too much in today's update. I do cover each trade alert that we're currently in great detail to open it up, and you can rewatch this after this webinar is over. Okay, guys, so let's continue on. Again, the big selling point to this program is that we generate returns in all market conditions. This is a great example. In December, when stocks puked 18% of their value in a month, we generated a 1% return. In February and March and January, markets rebounded. We didn't lose money. We picked up 2.2, 1.7%. In May, when the market sold off significantly, 7%, we picked up a 2.2% return. In June, it rebounded. We didn't lose. We picked up 3.2%. The last few months, we've been playing it ultra safe, trying to see what the heck was going to happen with the trade deal. We squeaked out a profit, and now we're playing the markets more aggressively. Next part of your trade alert, we're going to review how to get out of the last week's trade. So sell to close your put. And then the next trade in this example is to buy to open the January 10th, 2020, 44.23 put. By purchasing this put, we cannot lose a penny more than we are today. So we're paying that 61 cents for downside protection. And again, we cannot lose a penny more than we have today because it's all been put into the value of that put option. So if we do go up more than 61 cents by January 10th, we're in the money. And again, with massive amounts of money being added into the banking system, I'm expecting just about everything to travel higher. The next thing you'll see is a risk graph, which visually shows you your risk to reward. And so while we're risking around $60 a contract, we're potentially making 100, 200, much more if we just travel up a few dollars on emerging markets. So that's a review of today's trade. Let me go ahead and look at the news now, and then we'll open back up for Q&A. Okay, so here's the big picture. We have a lot of banks in emerging markets printing money, not China, but a lot of their partners are. We have the Federal Reserve printing $60 billion a month. We've got the Bank of Japan buying everything under the sun, as always. And you can see they rarely stopped purchasing anything for the past decade. And now we have the ECB, who was dormant for most of 2019, going full throttle. In fact, they've been teasing that they have a bazooka of stimulus headed our way. Now, this is not even counting the repo market. What's the repo market all about? Why are primary dealers hoarding treasuries? They could be flipping them for a profit immediately from the primary dealing purchases, auctions from the treasury straight into the market, but they're not. And the reason why is, one, maybe they're scared they would spike yields and they don't want to make their largest position go negative. But two, perhaps they knew the Fed would open up the repo markets, which gives them the sweetheart deal. What's the deal? Earn the interest of the treasury, put the collateral into the hands of repo. Now they have cash. They're loaning the cash out for more money, mainly to your stockbrokers. And then in the future, they believe rates will go lower following the rest of the world. And that means they can flip these bonds for a huge profit. So it doesn't get any better. And that tells you why JP Morgan has increased their bond position in 2019 by 50%. Okay, so what's going on in the trade deal? You're getting two stories, as always, one from US, one from China. US-China phase one trade deal has been absolutely completed, and US exports to China would double under the agreement, said White House advisor Larry Kudlow. Asked if officials still plan to sign the deal the first week of January, he said that's the hope. Go ahead and mute all. China warned of huge challenges living up to US trade deal, from the South China Morning Post. This is in Reuters. US-China trade deal announced here on Friday will be signed in early January. However, subtle but important differences between what US and Chinese officials say has been agreed upon have arisen in recent days, including about timing. The White House and Beijing have locked in a 17-month trade war punctuated by an agreement in principle that fell over specific details in May. U.S. Trade Rep Robert Lighthizer told reporters on Friday that the deal includes promises by Beijing to buy $200 billion more in U.S. goods and services over the next 2 years, a huge jump in China's imports of $186 billion in 2017. Officials in China have not confirmed any dollar figure. Chinese enterprises will import more high quality and competitive goods and services from countries including United States under WTO rules, as well as market rules and business principles, Chinese officials told reporters. As long as U.S. products and services are marketable and can meet the needs of Chinese people, expanding imports from the United States is something we would like to see. China could expand the scale of imports from the United States in energy, manufactured products, services as needed. A $50 billion farm products buy. Now, the catch with the $50 billion farm products is the U.S. doesn't even produce anywhere near $50 in aggregate agricultural to even sell. So we'll see. They're supposed to potentially sign this in Davos with Xi and Trump. But as always, these trade deals are short-lived. Chinese state planner, consumer inflation might be a bit high at the beginning of the year. Full CPI this year within the government's range of 3%. That's running hot. In fact, they're seeing food inflation of 4.5%, while earnings are starting to flatline. Imagine making $11,000 a year in China, getting taxed at a 70% rate, and you're watching food prices go sky high. Probably not very popular spot right now, and a lot of concern. Global Times, another voice of China. China will probably buy more U.S. goods next year, but that won't reverse the impact of the trade war, which has seen China pursue export diversification as breakthrough. So Brazil's been getting a whole lot of our agricultural purchases. Hong Kong's port cargo throughput dropped 7.4% year over year in November, a 4.1% fall in October. So Hong Kong's officially in recession, and the protests continue to rage on. Apple's iPhone sales in China fell 30% on a year-over-year basis in November. And now Apple's stock is up 100%, mainly from corporate buybacks. Xi Jinping's annus horribilis, Xi is experiencing severe weakness in his power. The leaking of 400 pages of the cultural genocide and organ harvesting in Xinjiang to New York Times had to come from a political rival. The U.S. set to finalize new rules to limit high-tech exports to China. So maybe this trade war is not just about a trade deficit. Perhaps it's more about a technology war. And I think we're now moving into phase 2 of the trade war, much less the phase 2 trade deal. Opinion: China appears to add a sickening new dimension to its treatment of Uyghurs, sending a whole population into a state-controlled environment of political indoctrination, social control, extrajudicial, internment, and massive surveillance with the effort of breaking up traditional religious and family life is cultural genocide. So this is the message that's spread around the world about China's behavior, and this is not going to wear off easily. Trump-US-China trade deal to be finalized in the next 2 weeks. This is the third time the phase 1 deal will be finalized. U.S. secretly expelled Chinese officials who breached sensitive Virginia facility. The Fed's balance sheet will grow $800 billion in 4 months from mid-September through mid-January. Donald Trump would be so great if the Fed would further lower interest rates and quantitative easing. The dollar is very strong against other currencies and there is almost no inflation. This is the time to do it. Exports would zoom. The overcrowded trade right now is growth and long tech, and it has been for a long time. Most likely will continue to do so until the credit market snaps, which we'll be taking a look at soon. Fed Kaplan: don't rely on the dollar remaining the world's reserve currency. In other words, warning that we do need to get control of our deficit. We're growing debt at a rate of 6%, and we're growing GDP at around 2%. So obviously that will slowly but surely force the Fed to lower interest rates, go into quantitative easing, and that works until we get to zero. USTR's Lighthizer: phase 1 China trade deal is totally enforceable. Yeah, the enforcement mechanism is just to go back to raising tariffs. So really nowhere except for where we've been the whole time. Fed's balance sheet, you can see the different periods when we did QE, QE2, Operation Twist, where they just started manipulating which bonds would expire. QE3 was massive, and now we're getting into QE4. So stocks are highly correlated to quantitative easing, and now we're going right into quantitative easing at all-time highs in stocks, record low in employment, and we just finished escalating the trade deal with China, perhaps. So why are the central banks so scared? Well, China's growth is collapsing, and the world's growth is tied to China's growth. So they know that this is not good. So there's our not QE. Why do they say it's not QE? Because they're only buying the very front end of the treasuries. So that's anything expiring in less than a year. They say that doesn't distort the long-term interest rates in markets. However, if you do study the yield curve, if you suppress the front end of the treasury curve, it sure as hell drags down the rest eventually. And now it's expected that they will start to begin purchasing some of the coupons and bonds and not just the T-bills. Here's where they expect the balance sheet to be in the next few months, which will have effectively reversed all of the quantitative tightening we pulled off in 2018 and partially into 2019. Took them a year and a half to do that. They call it a controlled burn, like as if you're trying to prevent a forest fire. It only took them several short months to print that right back. So you can just see how sensitive the market has become to liquidity. And this is because not just the US, but all governments have created more debt, which is creating currency shortages all over. Japan is leading China as the biggest foreign holder of treasuries. China's just running out of cash, so they're spending their treasuries to finance their economy currently. Dow gains 10,000 points since Trump's election, and it's been from tariffs. Everybody was swearing tariffs would derail the economy. Here's a look at San Francisco over 6 years. You can see the growth just growing rapidly. And now these tech companies are buying up all the property they can get their hands on. The liquid reserves of the US banking system are frozen. They're frozen in corporate debt and US debt. And that's why we must do massive repo and eventually quantitative easing. Otherwise, the money markets will not operate. You won't be able to transfer money from one bank to the other because it's all tied up in bonds. Central banks are cutting like it's a crisis. 51 cuts to close out 2019. Last time we had anything of this nature was back in the 2008 crisis. We had some cutting throughout QE1, QE2, QE3, and Operation Twist. But right now, it's not clear why they're doing it. Obviously, it's because China's GDP is crashing. Here's a look at the yield curve, and we can see as the Fed manipulates the short end of the curve lower, it's slowly but surely dragging the rest of the rates lower with it. Now they've only put their hands on the front end, and you can see just how much that went down from 2018 at the nearly 2.5 on the front end, all the way down to 1.5 on the front end. So we can see that the long end, the 20 and 30 year, can come down significantly, and that's where we have our TLT bet. Most likely, as soon as people take some profits in stocks, we get some bad data out of China, maybe out of Germany, we'll see our next rush into the bonds. At this point, the banks would prefer to just swoop up these bonds at as high of an interest as they can so that they can have a highest potential profit after the Fed officially cuts rates and starts up real QE on the medium and long end of the Treasury. So again, I do suspect TLT will be relatively flat against the SPY as the banks secretly load up on these as they have been and wait for QE and more rate cuts. And the next big spike will, again, likely come when we get a sharp sell-off in the SPY. Just think of May last year, there's nothing wrong. People just want to take some profits. They're up huge on the SPY. So I do suspect we will see some volatility in the SPY, but in the long run, my new target on the SPY is 260 plus. Rudy Giuliani, Yovanovitch was part of the cover-up. She had to be ousted. Donald Trump, the new US Today poll just out, has me leading all the Democratic contenders. That's hard to believe since the fake news and 3-year scams and witch hunts, as phony as they are, just never seem to end. Coming up at 11 a.m. Eastern, the House Rules Committee will be meeting on articles of impeachment against President Trump. This is the last stop before the full House votes on impeachment. There's some arguments about how the trial should go in the Senate. Will they be calling up Bolton, who I think would be the biggest wild card? Most likely he was fired by Trump, and he says he has story to tell. We got Lindsey Graham and McConnell saying they want to get this in and out as fast as possible and back to business, while we have other people who want this to be drawn out, get Joe Biden, Hunter Biden on the stand. So we'll see. Will we get a show? Or are they going to try to keep this hush hush and get it over with? We've seen one Democrat switch to Republican this week. So we'll see just how many are going to continue with the Democrats' impeachment. President has said that under Article 2, he can do whatever he wants. That's what happens in a monarchy, not a republic. As Benjamin Franklin said, America is a republic if you can keep it. Adam Schiff. Not a lot of content coming out. I have a whole Twitter profile that just tracks impeachment, and not a whole lot being said. They're being pretty quiet. Here's a look at the SPY ETF just screaming higher. And it's hard to believe we're at this level, but I truly believe we're going to 360 plus by mid-2020, unless we get some major trade problems. But when you print $500 billion, lend it to your banks. What do you expect is going to happen? TLT, the higher this goes, the cheaper money gets and the more rapid we can see stocks accelerate. It's crazy, but it's true. The higher the TLT goes, the cheaper rates are, the cheaper corporations can get access to capital, and the more bullish stocks will be. Now, what's the catch? There's a finite level that TLT can reach. By my calculation, it'll be around 180, and that's as we approach the zero bound on the federal funds rate. So we went from 2.5, was as high as we managed to get in 2018 before we crashed the stock market and the bond market for that matter. And they had to do emergency meetings and start the printing press and start lowering interest rates once again. So as we approach the zero bound, I suspect we can get around 180 to 200 on the TLT. And unless we start talking about negative interest rates, that'll probably be about as high as the TLT can possibly go. So that's when we'll start to get looking at that inverted option collar, because you can see the TLT is not invincible and it can have significant sell-offs. Now, remember, if the TLT sells off, that's going to spike yields and drive money out of stocks into bonds. So as long as the TLT is holding pace and slowly drifting higher, that's very bullish for our stock positions. Here's emerging markets in the long run. This is looking like an extremely bullish setup if they can continue to expand their debt with the Belt and Road Initiative project. We know that they can't buy any more ghost cities or ghost residential areas, but they sure can start building up this massive infrastructure project to connect many of the countries in Asia. I think it's like 158 countries they're trying to connect. GDX, this is going to go potentially well above 66. The 2010 crisis is, or rather the quantitative easing from 2009 through 2011, which gave the last big rally in GDX push to 66, is peanuts compared to the debt levels we're servicing today. So I expect massive quantitative easing in the next several years, which could potentially drive GDX significantly higher than it was in the past. Now, what could make this go wrong for gold? Number one would be if the Fed thought that everything's fine, that GDP growth is back on track, that governments are not going to create deficits that they can't fund, and that the Fed won't have to print money, and that they're going to maybe start hiking rates. Well, then you don't want to own gold. But that's not the case. The Fed and every other central bank in the world is doing the exact opposite. The governments are creating massive deficits, are trying to redistribute wealth by creating these deficits. It keeps their GDP up, and it forces central banks to print money and start to buy up the government's debt from its banks. So this is a trend that I'm very confident in. Risky banks, what else could go wrong? Well, certainly Deutsche Bank, HSBC Bank, Santander Consumer, that's your auto loans, and SoftBank have all been making some terrible bets over the last decade. They've lost a lot of money. They have, with WeWork, with SoftBank, I think Santander probably has a lot of auto loans defaulting. HSBC was trying to protect the UN against the dollar, lost a fortune. They've been firing tons of people at the management level. Deutsche Bank has lost 90% of its value. So all of these are certainly banks you want to track. If they start to tank, that's a warning sign that something is wrong. Here's a list of bond-related ETF products. We're not trading these specifically, but if either of them were to either spike up or down, this could be a warning sign. Just different bond markets, emerging market debt, high yield debt, different aspects of the treasury curve. So this just gives us a very quick way to daily monitor different parts of the bond market and look for any warning signs. If we do look at EMB, you can see emerging markets have access to cheap capital. The higher this is, cheaper it is for emerging markets to get access to capital. Here's HYG. This is your junk bond. So relatively cheap, not as cheap as it was in 2013. This is really correlated to the Russell 2000, but relatively, they can get access to capital. as well. So that's bullish for the midsection. Nothing is as bullish as investment grade bond ETF LQD. This is the one that Jeffrey Gundlach predicts will snap the stock market eventually. And this represents companies like Microsoft getting negative yielding debt in Europe. So they're getting paid to borrow money out of Europe, and they turn around and buy their own stock back. So you tell me, how are stocks going to crash if Microsoft can get paid to pump its own stock for free? It won't. So this is really the catch for the stock market, at least the top companies, not so much for your Russell 2000. They're still paying some debt. Here's another look at the yield curve. We can see from 2018, rates were much higher. We got that inversion, and the Fed immediately reacted and dragged these rates way lower, which is the blue line. Now, they only manipulated these three. So this is our leading indicator, and it's already starting to create a drag. You can see all of these prices are moving lower. That's bullish for our TLT, and I suspect that this will drop towards 2 in the upcoming year, and that these will potentially go much lower as we see the Fed start to lower interest rates. Now, with all this dovishness, you think the dollar would be in decline. How many times have you heard it's in for the dollar? Dollar's still sitting very tight. And as long as the government creates deficits, that's going to take dollars out of the banking system, as your big banks like JP Morgan have to convert their dollars into bonds. That's why we needed this repo, because the banks are out of dollars. So the banks are getting a killer deal. Once again, buy the treasury, get the interest, lend it to the Fed, re-lend the dollars back out to hedge funds, and then wait for rates to go lower so they can eventually flip those bonds for a massive profit, probably as they launch official quantitative easing. Now, I've pulled up the German 2-year bond. You think if everything was great in China, the front end of the bond market should be going up. Prices should be getting more expensive, but no, front end of the German bond is traveling lower. Great leading indicator for the bond market. Here's a longer 5-year look at the 2-year bond in Germany. Again, it's in a downtrend. If we look at the 30-year, which is more correlated to the TLT, once again, things are not easing. We're seeing money flood into the German bond market, signaling that the slowdown in China is a real problem. And that's because they export a lot of cars and different manufacturing products into China. The long-term look at the 30-year bond in Germany, again, this is an obvious downward sloping trend, and I suspect this will go much lower, back into negative territory before this crisis really comes to a tipping point. Okay, U.S. Treasury 2-year, once again, you think with the trade deal in the books that yields would be spiking on the front end of our notes. It's not. It's going down over the year. A little bit flat right here, but it's not really spiking up. If we look at the 5-year, we can see the obvious downward slope. If we go to the 30-year Treasury on US, it's not as bad as German, but you can see the lower lows are hitting lower points, and this is also in a downward trend. Gold, pretty simple. If the money supply is growing, especially worldwide, and gold availability is growing at a slower pace because they can't find it fast enough, well, the relative value of gold is going to go higher. So we're printing money. Gold is likely to continue rising. Central banks are trying to protect the credibility of their currency, so they're buying gold at record pace. Now, I think we'll have a hard time getting much higher than 1,500 without a major scare. But right now, the central banks are perfectly happy buying gold at this price level just to back up the value of their currency as they continue to print and print more of their fiat dollars. So that's why we like gold miners versus spot gold. Crude oil is in a nice uptrend, which correlates with our thesis that we think stocks are headed higher and that all this money printing is goosing up GDP. So that does line up with our expectations. Now, if oil gets too expensive, I'm first going to get concerned about the bond market because that means there's inflationary pressures building. And if, on the other hand, oil gets too cheap, that's going to show that growth is going to slow down. And in that respect, we would be scared for our equity position and happy for our bond position. Okay, what are the top currencies we need to keep a look at? CNH is the Chinese currency. Now, this currency is highly manipulated by the Bank of China. It was being manipulated by HSBC, but I think they lost a fortune. Big picture is after 2010 housing crisis, China's strategy of just building houses and flipping it to their own citizens back and forth to create artificial GDP numbers began to not work. And now that they've built all these projects and the loans are due, there's no one renting the properties. So there's no income to service the debt that built all these properties. So that's why China's debt to GDP is near 300%, and they've lost control of their currency. So unlike Japan, who in 1980 through 1990 was the hottest stock market in the world, whose Tokyo was supposed to be worth more than all of California, including Silicon Valley. Well, when their crash began in the 90s, Japan decided they wanted to protect their currency and their export business. And in fact, all they've been doing mostly is exporting their currency, buying up everything they could get their hands on, as we just saw. And that came at the cost of allowing their stock market to collapse and their real estate market to collapse. So we'll see what decision China makes in terms of dealing with this slowdown. But if you listen to their leader, President Xi, their goal is to keep GDP at 6% and keep on building. So to keep on building, most likely it won't be more residential and it won't be more skyscrapers inside of China. They realize they've overdeveloped. They've got enough buildings and airports and subways and bridges probably for the next century in China. In fact, in the last 10 years, they laid more cement than we have in the last century in the US. Now their plan is to expand again with the Belt and Road Initiative. So I believe they'll allow this currency to slowly devalue, which allows them to spend the 210 trillion yuan they've purchased. Now, if you're worried about your Bitcoin position, for sure it's because CNH has sold off, and this is scaring the Chinese who've been loading up on Bitcoin as they've been watching the value of their currency lose value over the course of the last 2 years, ever since the trade war began. And it's really since 2010 that China lost control of their GDP, which was always above 10%. And they've also lost control of their currency. Here's your 6-month view showing the strengthening of the CNH. Now, with this historic trade deal, you think that we'd be back towards 6.5, maybe 6.6, which is what I've measured as a strong strengthening of the currency. But it's barely budged 20 basis points, which shows you just how expensive it is for them to keep this conversion rate even at 7. Okay, the euro still weakening against the dollar. We're looking for any signs of the dollar weakening against major currency pairs. It's not there. Here's a look at JPY. Now, this is one of the few currencies that over the last 5 years has shown some strength against the dollar. And potentially we may see a big move up in the yen against the dollar as Japan's slightly protecting its currency by hiking rates a little bit from negative territory at the same time that we're seeing the US lower interest rates. There's your Bitcoin crash from 14,000 down to 7,000 ever since we've seen this de-escalation. The good news if you are long Bitcoin is that the trade war is not over and we're about to see more money printing than all in history. So I suspect you'll find some new buyers in the next few months to keep this alive and continue its ascent. All right, guys, that's a wrap up. Let's see, are you out there, Dean? You want to do your slideshow now?
Sure. Thanks, Jason. Hey, and just real quick, Jason, I know it's kind of a little bit more complicated, but why do you follow currencies in relation to the market? I think that's something, I have a general gist of, but I think that'd be helpful to explain just real quickly for our member base and our guest that's on here.
Okay, sure. Yeah, great question. And actually, let me unmute everybody. See if they have any questions in the crowd too. So I'm unmuting everyone. So I'll give you my thoughts on each currency. So one of our trades in our boot camp is I do want to short the Chinese currency, as I think it's highly overvalued. They claim that their 212 now trillion yuan are worth 30 trillion US dollars, but they don't allow the capital, their currency, to actually freely trade. We've seen every single time the Chinese allow their currency to devalue, shortly after stock markets have been riled. So this has actually been one of the best leading indicators that the US-China trade war is devaluing. And in fact, the super rich Chinese will front run escalations by trying to get out of the local currency before the escalation occurs. So this is a great leading indicator to the health of the US-China trade talks. And we've noted that every time Trump raises tariffs, Chinese allow the currency to devalue to offset those tariff costs. And this is creating a ripple effect through emerging markets, causing them to devalue their currencies, which continues to push the dollar stronger. And what's important about this is if the US dollar remains strong against other major currency pairs, and they have all their debt denominated in dollars, this means they're going to be in this sort of circle jerk where they have this huge debt due. It's denominated in dollars, and they're not creating enough tax dollars to pay for it. So they're forced to print their own currency and convert it into the US dollar. And so a big theme we've seen is that emerging markets are struggling, and they're funneling all their cash they can to all US products, including the dollar, the US treasuries, and the US stock market. So if we really think that emerging markets and gold are going to travel significantly higher, I'd like to see the dollar at least softening a little bit. So that's really what I'm looking for as a sign that emerging markets and gold will travel up significantly higher, is that we want to see our dollar soften a little bit. And we know that Trump really wants that because it would help US exports. And so Trump's trying to reduce our deficits and get a bigger piece of the export business in the world. Now, when we look at, for example, the euro, they have been running negative interest rates and a huge deficit with the US. So this is quite likely the next big target for Trump to go after, probably after the Senate trial. We'll see when exactly it happens, but they've been artificially keeping the value of their currency cheap so that more people buy their exports. So once again, if we see this trend continue, it's going to be a strain on gold as well as on emerging markets. So we may actually have a different decision on which direction we bet on emerging markets as well as gold, depending on how strong the dollar gets. So that's really the big picture there. Europe has artificially kept this price lower. Trump hates that. They've kept negative interest rates while we have positive interest rates. Trump hates that. And this is beneficial for Europe to have a better export business. Now, what's the cost? Their banks are going bankrupt. HSBC and Deutsche Bank are quite likely hiding some huge losses at this point. Now, Japan is a whole animal of its own. This is supposed to be the one of the two safe haven currencies. And you can see it's one of the few that's actually strengthened. Now, this chart looks like it's going down, but if you think about it, in 2015, we could get 120 yen. Today, we can only get 110. So at least there's one currency in the world that's actually strengthened against the dollar in the last 5 years. Now, that's not a very big move. And the short-term move in 2019 is that it's been weakening. So once again, big picture is if we want to believe that China is going to recover from its GDP crash and that we're really going to have a worldwide recovery, then we don't want to see the dollar continuing to be so strong at the same time that we're cutting interest rates and printing so much money. So that's really some of the main reasons I watch these big currency pairs. Now, if you do watch my piece on Hong Kong from our boot camp program, we take a look at the top 20 currencies in the world. and it's horrific. Over the last 10 years, there's two currencies who've been able to maintain their value against the dollar, which is, well, three. We have the Hong Kong peg, we have the Singapore dollar, and then perhaps, at least in the last several years, the Japanese yen. Other than that, all 17 currencies worldwide, their value of their currency has depreciated anywhere from 15% on the smallest end to as much as 90%. So if you had interest payments of, say, $1,000 a month and your currency loses half its value, now it's going to cost you twice as much of your local currency to service that debt. And as you keep printing that money, it makes the problem grow worse and worse. So that's the big picture. If we have a strong dollar, that just destroys capital markets and currency valuations around the globe. And I watch Bitcoin also as a feeling, you know, if Bitcoin really went back to 3,000, then that would be a sign that, wow, people all around the world are starting to reduce their government's deficits, the value of their currency, and they want to just own normal fiat. Now, I just don't see that being in the cards when we know for a fact that we're entering this period right here. Massive quantitative easing, expanding balance sheets, which will, of course, devalue currencies. Now, we have seen the dollar and gold go up, but that only worked together, but that only worked with all the other currencies depreciating. So we'll see if we're going to potentially get the dollar to slow down a little bit, which could be very bullish for our whole portfolio, really. Any other questions out there? Do you want me to flip it to your screen now, Dean?
Sure. Folks, any questions at all out there? Looks like we have Fred Cook. I haven't seen you in here in a while. Thank you for joining us. John Segro, Karen, Mark, Pete. Any questions out there at all, folks? And just feel free. I'm going to go ahead and unmute everyone's microphone. Just jump in and ask any questions you might have, okay?
Okay, I think I made you the host, so you can take over the screen now when you're ready, Dean.
Yep, I got it. Okay, cool. Perfect. Any questions real quick, folks, before I switch it over? Okay, so I wanted to spend a little bit of time today just going over a quick testimonial that we got from one of our members. I think this is kind of neat, just kind of what he says. It kind of summarizes some of the reasons I really like it, okay? This came from Oscar V. Has been a longtime client of ours. He said, I'm particularly impressed by the program and that it takes the worry out of risking your capital in the market that is driven by headlines and increasing volatility. Yes, I can lose money, but certainly not anywhere near the amounts I would without this program. My results have been equal to slightly better than the overall market, but with far less risk. What is better than that? Okay, and that came from Oscar V. And I just wanted to touch on that before I jumped into this. And I think for those of you that aren't members with us at this point, this rule has really struck home for me. I lost a little over $250,000 investing when I was very young in my career. And as an end result of that, I ended up reading, probably about 25 different investment books. Read every single thing that Warren Buffett's been a part of. His autobiography is fantastic if you ever get a chance. But I'll never forget when I was studying Warren Buffett, I found this rule that he came up with. And rule number one is never lose money. Rule number two, don't forget rule number one. Okay. He's a pretty successful person, the most in the world in the investment niche. So I've kind of always taken that to heart. And I think really the basis of what we've created mimics and kind of idolizes this rule. Okay. So this is kind of what we do every day, right? And just real quick, guys.
Dean, do you want to put your screen up?
Oh, yeah. Sorry about that. Thanks, Jason. I forgot to turn it over. Sorry, still getting used to this technology here. Okay, here we go. Sorry about that, guys. Here's back to the image I was wanting to touch on. But Warren Buffett's number one rule, right? Never lose money. Number two, don't forget rule number one. So sorry, I had to go back to that for a second there, but appreciate that, Jason. Let's see here. This is an overview of the daily presentation, kind of what we touch on. And just wanted you all to have a good idea of what you're going to need to have to get the most value out of the service. Okay, number one, a brokerage account set up to follow our trading plan that has options trading enabled. You can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Our minimum allocations will need 75,000 for the full service or 35,000 for the light system. Okay. You're going to need the ability to take 1 to 2 minutes to follow our trades every day at noon Eastern Standard Time. Okay. These alerts are by no means time sensitive at all. They simply need to be placed before the market close at 4 Eastern. So what's your window that you have to place the trade in every single day? Can anyone answer that for me? Maybe existing members, I'm sure you've done it before. All right. Well, you have so folks, it's basically a 4-hour window that you have from noon to 4 Eastern every single day to get the trades in. Okay. And it'll probably take you a minute or two when you start, but the more you get comfortable with it, it will probably take you closer to 30 seconds after about a month or so of doing it. Number three, one of the things that you'll need to get the most out of your membership is a mobile phone to receive our text message alerts. Many of our clients take these trades on the go from the airport, restaurant, in the car, wherever you have service. Is everyone currently receiving the text message alerts that's on this webinar? Can you just unmute your mic, say, let me know if you are getting them. And if you want to go ahead and jump in or, type in the text box, please just let me know for some reason if you're not getting the trade alerts currently. Okay, so I'm going to take that as a yes, that everyone's getting that. If you don't get those for some reason, text me immediately right now. My number is 505-322-7515, and I'll be sure to add you to the distribution list. Okay. And it's, obviously it's very important that you enter your cell phone number when you sign up for the trial. We've noticed about 20% of the people that sign up for the trial are not doing that. So definitely email or just text me. But you can email Ryan at portfoliobuilder.io or just text me at 505-322-7515 so we can get that cell phone number added to the distribution list. You're obviously going to need an email provider that's in good working order so you can look at all of our trade alerts that we send out. Okay. I highly recommend replicating our trading plan with $300,000 to start, so that you can make our 1% month target return. You can really have that pay off during your 14-day free trial. Okay. And more than 30% of our client base has paid off the cost of their annual membership during their free trial. My goal for 2020 is to get that over 50%. Okay. One of the ways you can absolutely do that is by using, a halfway decent amount of capital behind this. If you look at this presentation and you have a half a financial sense about you, you're going to easily see that this is one of the safest ways you could ever invest into the stock market. Okay. So, why not put some money, test it, and, make more than the cost of our membership during the trial period. And if you don't want to use real capital, hey, I understand. Use it on your paper trading account, replicate it with 300K. Would love to see the results during your free trial. Okay. And then just another easy way to think about things: for every 100 shares of SPY you're going to have 200 shares of EEM, TLT, and GDX. Now, yes, you can get the full balance of the system with $75,000. Okay, but just a lot of people don't get as excited about making 1% on 75K as they will, 400K or 300K. And actually, as the system has now clocked 1% in time since we've released it, we've averaged closer to 1.25% return per month. So, with 300K behind it, you're going to see results quick. Yeah, you're not going to be gambling. Yeah, you're not going to hit, 20% runs in the market, but at the same time, you're not going to see those 50% drops and, lower quality things that you could be invested in the U.S. stock market. Okay. So really, folks, that's it for me. Just want to quickly reach out and touch base and see if there's any questions at all in there. I know we still have 11 people out there, so please, team, feel free and unmute. If we have any existing customers that want to unmute their microphone, share their experience, that'd be greatly appreciated as well. And if anyone's a customer or anyone's not a customer at this point and has a question for an existing customer, please feel free to unmute. And we have quite a few customers on here that will be happy to give you live feedback. Okay, and folks, the easiest way to find your microphone is if you scroll to the bottom of either your computer screen or your phone, and you look in the bottom left corner, you're going to see a little icon that looks like a microphone. Just touch that. It will unmute your microphone, and then you can interact with us live here.
Hey guys, sorry I've had a couple distractions here, but yeah, just to let you guys know, I mean, I'm a lifer. I saw the value early on, and it took me a little while to unwind some stuff that I've had that I had to reevaluate how I wanted to do that. And as I said earlier on, and when this webinar started, I just unwound what I needed to in order to finally be able to get fully into the program. So to me, there's a lot of value in this, where there's growth without the risk, and that's very, very important. I'm going to continue to evaluate, before putting more on. I'm doing exactly kind of what you said, Dean, starting out with a certain amount. And I'm going to test the waters because that's me, I'm the ever skeptic. But so far it's, you're living up to what you guys have stated. It makes a lot of sense. And I'm going forward. And that's why I've been continuing to use the program. What I also like is that if I want to engage with you guys, I can, and I don't have to if I am too busy. And a lot of times in my life, I am. And then I just go ahead and put the trades on, and I have the confidence of knowing it's secure. So that's also a convenience as well with your program. So I just thought I'd point that out to some folks too, because I do like to hear what you're saying, because I'm one of those big picture global type of looking at everything because of stuff I used to do years ago. So I do hear things that, I pull from the back of my memory banks and go, this is one to look at. But, I know you guys are doing it now. So, if I'm not around, or if I haven't engaged, it's got other stuff going on. I know you are, and then I can always go back later and try to catch up. So it's very good. It's like a fail safe, your program. And I very much appreciate it. So thanks guys for what you do.
Awesome, Karen. Thank you so much. I appreciate the heartfelt feedback there. All right. Anyone else out there? Any questions? Please feel free to unmute, folks. Join in. Don't be shy. There is absolutely no such thing as a stupid question. I actually pride myself on asking questions as often as possible. I think it's one of the best ways to learn. And I think that's part of why I've developed some of the knowledge bank that I have at this point in my life. I'm still young, but I'm just always absolutely fascinated by the financial markets. And one of the fun things for me, and I know Karen and I have talked about this a couple times, but it's always changing. It's always in flux. So there's just kind of no end to what you can learn about it. But I think one of the things I've learned from Jason that's really been a huge help to not only my investments in the stock market, but investments in life outside of equity market is understanding how the financial system works, right? And that's something he kind of taps on daily, but goes into greater depth in the boot camp with. So yeah, so please, folks, if there's any questions, please feel free to unmute. Let's see here, Mark, you want to unmute and let me know how your first few weeks with us has been? I know you're still new here, but I would love to hear feedback from you. John Segro, I know you're out there. I know you've been with us for a while. Fred Cook, I know you've been with us for quite a while as well. Any feedback, folks, questions, comments? Mark, I see you have your microphone unmuted. Is there anything you have a question or comment about, bud?
No, I'm following along, trying to get my accounts situated. And I did find that Thinkorswim has some pretty good videos available on exactly what options are and how to maneuver them. I kind of think of it like learning to drive. I understand the concept of driving, if you will, or trying to learn how to drive a stick shift. I already knew how to drive, but it's a little herky-jerky in getting the mechanics of how to pull off the coordination to do the various aspects.
Sure. Okay. Good. And yeah, and Mark, really, the way we structure options, it's, at least with our main system that we do, the only reason why we structure and engineer the options that we have is to, we're already in a safe car, right? With the way the portfolio is structured.
Right.
But we're going to put you in literally the 5-star rated, crash test proven options, okay, in engineering and your positioning. So I think it's good to understand the mechanics of them, right? But it's also really good to understand the methodology that Jason and I have behind the system, right? It's always to have you all, in the safest setup possible, okay? And so that's why we utilize options for this system. It's literally just to add protection for you.
Right.
Cool. Awesome, Mark. Appreciate the feedback. Any other questions, comments? Okay, it looks like
I do have one that I'm sort of, because like I said, I'm trying to get things arranged to move into it. Should I wait to have everything together and do the 4 different funds on the successive days, or can I do it partially as I'm going?
yeah, so what you're going to want to do, Mark, is trade each. So you know how we sent out the EEM trade today?
Right.
That's what you're going to want to trade today. Okay. And if you don't have the SPY at this point, wait for tomorrow. Okay. And if you want to, for the first couple of weeks or so, to place everything on paper trades before you use real capital, that's a phenomenal way to just get familiar with the process of replicating our trades without using real money too.
Okay.
Okay. But always though, no matter what you do, if it's paper trade or real capital, wait till the day we send out the trade alert. That way we can add, the option protection on top of the underlying asset.
Right. Okay.
Okay. Does that make sense?
Yes.
Okay, cool. Yep. Yeah, and as Karen said, it gives you a hands-on feeling, and I absolutely agree. Okay, cool. Anyone else out there? Any questions, comments? Is everyone liking the daily presentation opposed to the once a week or twice a week presentation we were doing previously? Okay, folks, it looks like we've addressed everyone's questions to the satisfaction here. And definitely feel free to save my number. Call me after the webinar if you do have questions. And I'm gonna go ahead and put that number up really quickly. And once again, folks, my name's Dean Gallagher. I'm a partner here and investment coach with Portfolio Builder. And you can always call me. My number is right here at 505-322-7515. I look forward to speaking with you. Love to look over portfolios with our potential client base, see what they have that may be too risky, maybe see where they're underinvested. It's always nice to just go through that. There's no fee to do that, right? It's a free value add that we have during your trial, and yeah, it's been fun to find malinvestment. It's been fun to find underinvestment, and I've learned about some interesting investments through people that are doing things outside of the market that I'm now connecting with them and structuring in different places around the United States. So I look forward to finding and working through that process with you all. Cool. All right, guys. I think we've covered everything for the day. Like I said, call me if you have any additional questions. Okay, 505-322-7515. Want to thank you all for your time and energy for joining us today. And please feel free at any point to reach out with any questions you may have. Have a wonderful day, folks.
Thanks, guys. Thank you very much.
Yep. Thanks, Jason.